Before we do that, let's shift focus to the global Fintech Fest. Kamath, the chairman of Geo Financial Services, spoke exclusively to CNBC-TV18 from the sidelines of the GFF. Ritu was in conversation with him, began by asking him about the recent regulatory changes announced by the RBI.
I look at it on a very broad frame, as it were. If I look at a few years back, what a bank could do, and where we were at this point in time. For a variety of reasons, banks which were primarily in corporate lending, working capital and corporate loans, and also infrastructure credit. So one side of the book, more than 50% was these type of assets. The other side was retail assets. That has flipped, and particularly post-COVID, that has flipped in a very hard way, where you now have a majority of the assets retail, and then you have corporate. To me, what it meant was that banks were missing out on opportunities in an economy which is growing around, let me round out the number, at 7%. So in a 7% economy, the key driver is going to be your corporate side of the economy. And the banks were somehow getting left out of that sector for a variety of reasons, some of which have been now tried. There are other reasons which are more structural. For example, there's greater access to capital markets now, which till 5-7 years back, the pension industry, the long-term savings industry, the insurance industry, the MF industry was still growing. But now it's growing at a pace. So good corporates, large corporates can access that market directly. And so the banks, in a way where you could see in their capital adequacy, their capital adequacy was very flush, as it were. So I think this opens up equal opportunity in a way for banks. And to me, it is excellent news.
But, in terms of signaling from RBI, do you think this is a very different regulator than what we had a few years ago? And, is the signal that this is a more growth-friendly regulation, or as some in the industry have expressed concerns, some of the dilution of prudential, guardrails as well?
No, I don't agree with that second proposition upfront. In my 55 years in business, I have not seen the RBI, not taking its eye off the ball. They're never ever. They are always very focused. So that is not an issue. In terms of various regulators, regulatory heads doing various things over a period of time. Again, when I look at things over time, and particularly from '96, when I was in a, I'd say, position where I could take a better look, regulation has always followed what is possible given the environment. So we must remember, sometimes we don't put it into context. We hit $500 billion as a GDP only in 2004. So the regulations that were appropriate for that period of time were in place during that point of time. That is, as we headed from $250 billion to $500 billion. And I think it took us 20 or 25 years. Regulations were appropriate. And we might have had views on that, but they were appropriate. And then growth started, momentum started. And we could see easing happening. So I would think that at each point in time, every 5 years, let us say, in RBI, I have seen an evolution in terms of how they look at what they need to do in the context of the overall economy, in a policy construct and a supervisory construct. So I think what they have done is appropriate, considering where we are
at the moment.
This moment.
Sir, M&E financing, how significant is it allowing banks to finance acquisitions? Because, what has really changed from RBI earlier not wanting to allow banks to do it to now, changing its stance on the matter?
We actually have to go back to answer this question many decades. And some of us, I think, are too young to have understood why this was not done. So there was a period of time when we thought acquisition by one company of another company typically is a hostile route. And that the bank should not be an instrument in doing this. So this was long back. So I think that has now been set right in current context, where everything is the market and everything goes through the marketplace. And in any case, if acquisition financing has to be done, there are other people providing private credit to do this, or you go through the capital market route and do this. So I would think looking at the risks at that point in time, the way business was being done at that point in time, that was something that was not allowed. And now, in a completely different context, I believe the Reserve Bank has done the right thing to open it up, because it's an excellent avenue of business for banks.
Yeah, how much credit do you think all of these measures put together could really unlock? And more importantly, while this is an enabler for banks to lend more, is there real demand on the ground from corporates, given the deleveraging cycle we've seen and the global uncertainties?
There are two different things here.
Yeah.
Deleveraging, I think, is now a mindset issue with the Indian corporate. They will not leverage themselves, by and large, the larger companies. I think at the MSME end, that will happen in due course. But we are talking of the mid to large corporates. So it's not a question of deleveraging. This was for business purpose and acquisition. And in most cases, these acquisitions are in a friendly mode.
Not hostile takeover.
So now you need to, it's not hostile, but you need to understand whether there are risks. What are the securities? What is the underlying value of those securities? All those, that analytical skill is required, and I'm sure banks will come up to speed on that. Now, your question was, is there demand? I'll say this, I'll not put a number to it, but every single, I would say, global entity that I talk to, of whatever type, if they are in the financial services business, so I'm not naming it is a bank, non-bank, investment bank, I'm saying every single entity in the financial services business globally was looking at India as a great place to come and set up a private credit business. Bringing in external funding and then providing this credit which Indian banks were not allowed to do for the marketplace. So the curiosity that was there, the interest that was there, and the opportunity that they saw, to me means that it was a very large number that is being talked about.
All right, well, time to slip into a quick break. Come back, continue to focus on markets and stock-specific action. Stay tuned.